Let's start with the basic proposition. A tax is a fiscal cost for somebody who does something somewhere. And if you change who does it, or what is done, or where it's done, you're going to change the tax consequences. To pick a simple example, companies normally pay a different rate of tax to individuals. So if the business is run by a company, you will pay one rate of tax. If it's run by an individual, you'll pay another. What globalisation is doing, simply because it's so easy nowadays to move the factors of production around, is it is encouraging governments as far as possible to see their tax system as a means of attracting investment and promoting development. That's particularly the case in Eastern Europe, where for a long time you didn't have much in the way of a social safety net, and now governments are trying to build their economies. There are complaints about that, of course, from time to time by the EU, who would prefer everyone to have a higher tax rate. So one of the consequences of globalisation is tax competition. The other thing that's important as a result of globalisation is you want to make sure that people pay the right amount of tax, they pay it in the right country, and they pay it only once. Let me give an example. Somebody who's living in England owns a factory in Montenegro. Under English tax law, you pay tax on your profits wherever you earn them, anywhere in the world. Under Montenegrin tax law, anyone in Montenegro who carries on a business that makes a profit pays tax on the profit that arises in Montenegro. So you have a situation where both England and Montenegro might make a claim to tax on the same profit. That's obviously going to disrupt international trade. That issue is dealt with by a series of international agreements called double taxation agreements. Montenegro has signed quite a lot of them, and they effectively allocate the profits between the country where the profit is made, or what in tax terms is called the source country, and the place at which the ownership of the profits is what in tax terms is called the country of residence. And how that is allocated really depends on what is done and how it's done. For example, the rule in relation to businesses is normally that you pay tax in the country of source if you have what's called a permanent establishment there, which is a substantial business of one sort or another. If you don't have a permanent establishment, there's no tax in the country of source. Tax is paid only in the country of residence. What is then provided is that if tax is paid in the country of source, the country of residence will give a credit for the tax that's paid. So that, for example, if you have a business in Montenegro that pays tax at the standard tax rate of 9%, when you get to England, where the tax rate is higher, you will take off the 20% tax rate that applies in England, the 9% that's been paid in Montenegro, so that effectively you pay 11% in England. That's oversimplifying it, but the basic idea is that the profits should be taxed once, that the countries that have a claim to it should be able to, on a rational basis, work out who gets first bite at the cherry, if I might use that expression, and then the country of residence takes the balance.